Okay, so Dave, we are pretty fresh off the election.
Yes, indeed.
No matter who you voted for, I think there's still a level of people kind of going, okay, what's going to happen next? Once January hits, once policy starts to go into place. What are your thoughts on where people are at and how that impacts our financial market with real estate?
Yeah, look, I think anytime you come up on a presidential election, right, this is really changing the course of the country for the next 4 years.
Yeah.
So it's a big deal. The financial markets are heavily involved in that because as we found out in this election, the economy was the driving force that took people to the polls. And in fact, many people were shocked by some of the results. And maybe, there's a lot of discussion out there that maybe there wasn't enough focus on the economy. And that's why, the administration that's going to be taking the helm over the next 4 years is who they are. But look, but in any facing any type of presidential election, it is a big deal. And if we look at that compounded on top of like the last 30 months, which have been difficult for Americans, right? We've been on this like crusade against the fight towards inflation. All the copy points you're hearing is it's double the cost to fill your grocery cart this year than it was at this time last year, and how that's impacted people on Main Street. So yeah, people were on pins and needles, right? Like leading up to here, to have an idea on what the fiscal policy is going to be like moving forward. Prior to the election, however, in September, very recently, the Federal Reserve came out with like a very staunch decision saying that, hey, the worst is behind us. It's now time to start looking at alleviating the pain of Americans, right?
Yes.
And sort of right-sizing what has been the most the most firm fight against inflation in the way of raising interest rates over the last 30 months. So prior to the election, we saw things starting to tick down, but that wasn't the case during the election. The day after the election had quite a different impact.
Yeah, I was going to ask you that. So it's interesting you say that because you're behind the scenes. You're the one who's seeing the interest rates float up and down every single day. Do you feel like the election results had as big of an impact to mortgage rates and just the real estate financial industry as we thought they might be?
I think bigger, in fact.
Okay, tell me about that.
Yeah, so, well, I don't know if you have a 401k or you invest in mutual funds. When we woke up the day after the election, everybody was smiling, right? Everybody's investments accounts were up. The stock market opened up huge, both the Dow and the NASDAQ. And that's, it's very simply because Trump is pro-companies, pro-industry, pro-corporations, right?
Pro-real estate.
Pro-real estate.
He has a lot of it.
Yeah, absolutely. He's definitely a real estate guy. I think that's something we all have to look forward to, at least in the next 4 years. But, when that happened, a lot of money internationally came into the United States. There's big discussion about reinvesting, about bringing manufacturing back into the United States. I think companies are feeling like from a taxation standpoint, they're going to have a very clear path to being able to invest in R&D research and infrastructure and building the factories and hiring the employees,
Yes.
Without facing, very staunch tax rates into the 30% range. So companies are excited. Industry is excited, and that was reflected in the stock market. However, when that happens, that generally has an adverse effect on what mortgage interest rates do.
Yes.
So it's kind of like contrary to like the layman's way of looking at it. Like when you're looking at the stock market doing really well and unemployment is low and cranking away, like you would think, hey, that's really great, right? And it is. From an economic standpoint, it's really great. But when things are really great, interest rates go up, they don't go down.
Isn't that funny?
Yeah, it's an inverse relationship. So, it's on one hand we're doing high fives like, hey, check out your 401k, but interest rates shot up big time.
But Dave, we want to have our cake and we want to eat it too.
I know we do, but I think that some of the policy, especially as it pertains to the economy, are going to actually allow us to do that. Like I think we're setting ourselves up for what will be a good run, but unfortunately it's going to get a little hairy before it gets better.
Yeah. Okay, so talk about that. What do you think the trends are that we can expect to continue?
So we're going to be in the dark a little bit until the new administration actually takes the seat, right? Because right now what you have is a lot of discussion and plans, and you hear these big expectations for international tariffs, right? That's the big one right now that's affecting the market. And I'll just give you I'll unpack that here for a second, right? If we impose a 40% tariff on importing goods from China to the United States of America, that 40% tax is not going to be absorbed by the company that's manufacturing.
No way.
That's going to be passed over to the end consumer, which is simply going to raise inflation. I mean, the definition of inflation is the increased costs of goods and services. So if something that you paid $5 for now costs $7, that's a reflection of inflation. So the market's concern right now is that we're going to see inflation pop up if these tariffs are enacted. And that is sort of contrary to what the Federal Reserve has been doing over the last 30 months, which is trying to beat inflation downward.
Right.
Right. So you have like two kind of converse things at play there. Now, I think, again, you mentioned it. Trump is a real estate guy.
Yes,
right? So it would make sense that when you're trying to appease the American public and really make them feel better and ease the pain at home, the home is an important piece of that.
Yeah.
Right.
I don't foresee him throwing us in the deep end. I just don't see that happening.
No, I mean, the economy is a big thing, and it's not really controlled by one person, right? I mean,
Right.
that's the beautiful thing about capitalism, is that there's just
what I
a
love
lot of
about
different
America.
things. Like, yeah, you got to love it. But as far as tariffs specifically, you got to imagine that there's going to be a responsible rollout of that. I mean, those tariffs are not just designed to like give the finger to other countries, right? They're designed to bring American jobs in manufacturing back to America. But it's going to take time, right, for companies to build factories and staff up and bring the machinery and the infrastructure that's needed to effectively do that. So you got to imagine that the government's going to work with these big companies and have it be in their best interest to start that process instead of just like smacking everybody in the face
More of a
overnight.
partnership.
Yeah, it's going to be a partnership. So if that happens, which I believe is the responsible way to approach that, I think that the market, once the administration takes the helm and starts enacting not rhetoric and words, but starts putting policy at play, I think that's when the markets really calm down and say, okay, I think we're going to look good from an inflationary standpoint, and we have the economy doing well, which is ultimately what we want in the country.
It is. I'm actually really excited to see what happens in the first, after that first quarter of 2025.
For sure. I mean, look, with investments all pop, because that's what the stock market is, right? It's investments. Everybody who has investments, crypto went crazy overnight. The Dow went crazy overnight. Futures started trading higher overnight. Well, your home is also an investment. So that lends to the fact that home values should be protected, they should be strong, and they should continue. Like I said, I think we're setting up a nice era in front of us as it pertains to real estate specifically. Yeah,
I actually was reading an article earlier this week, and it was saying that home prices will grow by an average of about 2.5% nationally in 2025.
Yeah, I believe it.
Freddie Mac was predicting 0.6%, Fannie Mae 3.6%, National Association of Realtors 1.8%, and Goldman Sachs 4.4%. There was actually 10 different financial institutions, and the 10 together is what averaged that 2.6%. And that growth overall, it's far less than what we've seen over the past few years. I mean, we were seeing double digits. Every week I'm posting, hey, here's the weekly market inventory update. And every month I'm posting, hey, here's what's going on year over year in our cities. And it was just month after month after month, those double digit increases. And every conversation I had with people is that's not sustainable.
It's totally
it's not healthy, frankly. Right. I mean, hey, it was great. And the amount of equity that our homeowners have built over the past several years is pretty darn exciting.
Sure.
But, it all has to do with demand. It's all supply and demand, right?
Sure.
Simple economics. And as more buyers return to the market, as we have got past that election season, we're getting past the holidays, the typical seasonal things that we see, the demand will rise. However, at the same time, so will supply as sellers are, if we start to see the decrease of interest rates, not like how everybody would like it. We're not going to be back down to those
Yeah.
COVID levels, so to speak. Nevertheless, if that does trend the way that they're wanting it to trend, there's also going to be more homeowners that want to make that transition. And overall, I think it's, the inventory are still below the norm. It's going to put an upper pressure on prices in those areas where the inventory is still a little bit of a challenge, but supply will help keep price growth in check. There's that balance of the new inventory hitting the market and then the buyers that are there. So while prices will rise, I think it's just going to be at a more moderate and healthier level overall.
You bet. I mean, that's really what the market is sustained to do.
Yeah.
10 to double-digit appreciation year over year. If you're a homeowner, that feels really great, right? But at the end of the day, we have to understand that a healthy real estate market doesn't just consist of homeowners. It consists of home buyers. And it's really, really important. And it's also important to the home sellers that we have a healthy market of home buyers. So it's in everybody's interest to have a little bit more of an equilibrium.
It really is.
Right? And as far as interest rates are concerned, they will go down. It is no longer a question on what the future of interest rates look like. The question is always the when, right? The when and the how much.
Yeah.
But we have gone through over 30 months of the most staunch and dedicated increases in interest rates for a very specific purpose, right? To bring on American pain. I hate saying that, but Fed Chair Powell said it in his words that unfortunately, to fix the problem that we have with inflation, it's going to be on the backs of Americans. That's the only way. We're going to have to see jobs suffer. We're going to have to see people in pain. And it's not a fun way of saying it, no. But it's just how economics work, right? That's part of the issue that we've had here when, in September when the Fed said, okay, we're ready to reverse course. We're ready to start clicking this baby down. And then the stock market goes up 1,400 points in a day. It's inconsistent with each other. And that's where a little bit of this back and forth is happening right now. But it will most certainly, this is truly the beauty of America. No matter who's sitting in that chair, Americans will work this out.
So
right?
True. That's what
really
I love about our country is that
amazing.
we do pull together. We find those solutions. There's always a solution. It's just the creativity that's needed and the such intelligent minds that we have in this country.
For sure.
The people that we put in those positions and what they're going to do with it. So
well, I mean, look, if you fast forward a year from now, right, and interest rates are in a healthier position, meaning they're a little bit lower, right? Now, again, you hit on something really important that I think is a key point to convey to people, and I don't think the real estate community cumulatively does a good enough job of doing this. There's a lot of people right now that are like, hey, I'll just wait till they go back down to 2.5%. 3%, unless some guy in Thailand eats a caterpillar and we do this all over again, there is very little likelihood that is going to happen. And that's not a good thing. And interest rates went down to that 2.5%, not because things were good. It's because things were really, really, really bad.
And we don't want that.
No, definitely.
We don't want that. But you know what, Dave? I think the overall message is a positive one. We've had a steady change of expectation over the last 2-3 years. And I personally think that will continue. It's been slow. From what I've seen from my seat in the conversations that I've had in talking with home buyers and home sellers, it is steadily changing. And I think education is important now even more than ever.
No doubt.
And I know both you and I are very passionate about that. And one of the values that both you and I have for how we run our business is empowerment. And I think it's important to, number one, to have resolve in knowing what you really want and what you're trying to achieve in real estate, and then being empowered and having the right team there to lift you up and help you get there. And I think that that's so vital right now in the market.
No doubt.
So, but you know what, Dave, I'd love to talk about from then to now, because history helps us put the present into perspective. And I would love to have more of a conversation on that. Would you join me on that and give me your thoughts on that
Oh my
next
gosh,
time?
you bet. I mean, it
Okay.
is such an interesting, like when you get kind of the bookends on this, right? Like we talked today a little bit about what we're kind of forecasting to happen, lower interest rate, prices staying tight, things like that. But when you understand it from like how it all started, it's really fascinating.
Yes.
How this works. And a lot of people had really different net effects, right? If you were a buyer, things got really pricey, affordability challenges, all the things like you said, right? Because it's not just about your mortgage payment. When you're paying more at the gas pump, more at the grocery store,
It's
more for
everything
your
together.
electric bill, all of that affects affordability and somebody's ability to step into homeownership. But yeah, I would love to have that conversation because every
do
time
it.
I do that with a buyer, I feel very blessed to work on the financial side of this because it's not very emotional, right? It's very tactical. It's very like factual based, and one family's experience with where things are at like yields a completely different result than a different family, depending on
So
their
true.
short and long term goals. So I love having this conversation with people, and when I do, you see that like, oh, that moment where you're like, all right, did our job, right? We really gave them and put them in the driver's seat so that they could start dictating what's right for them and their family instead of having people dictate that on them.
I love that. Let's do it. Let's
do
have
it.
that in the next conversation.
For sure. I'd love to
People
do
better
that.
tune in, huh?
Hopefully they do. Come chat with us.
All right, my friend.
Cool.